The second largest bank failure in U.S. history just occurred. First Republic Bank was seized by regulators and its assets were sold to JP Morgan.
The news this morning is that JP Morgan is acquiring First Republic directly from the FDIC, which seized and immediately sold the faltering bank. This transaction, the result of a competitive bidding process, at least according to the FDIC and JP Morgan, includes a majority of First Republic's assets, including $173 billion in loans and $30 billion in securities.
This is on top of 3 other large bank failures in the last couple of weeks. In fact, 3 of the 4 largest bank failures in U.S. history have occurred over the last 2 months. There was many people who thought that the banking crisis was over, but it may just be beginning. Now, what's interesting about First Republic Bank is that it didn't happen overnight. If we go back and we look at Silicon Valley Bank, that happened in less than 36 hours. And then by the end of that weekend, Signature Bank was also taken into receivership. But what we are seeing here with First Republic Bank is that they not only had weeks and weeks to try to fix some of the issues, but also number of the big banks put more than $30 billion in to try to help First Republic Bank become more stable. All of that help and all of that time wasn't able to save First Republic Bank. The second thing is that not only is the magnitude of the problem a big issue, but also this comes after the Federal Reserve, the FDIC, the OCC, and other regulators around the country created all sorts of different systems and programs, whether it be lending programs, discount windows, or others, to try to stem some of the problems from this banking crisis. Not only did First Republic Bank have time, not only did they have support from the big banks, but they also had support from the government, and it still couldn't save them. Now, one other area that I'm paying attention to right now is that Warren Buffett and Charlie Munger, they aren't acting. As we know by looking at their portfolio and watching interviews of them from over the years, they love banks and they love financial services. If there were banks that were in trouble and those two thought that they were great assets that they could hold for a long time, they'd be acting. And so the silence coming out of Omaha is deafening. If Charlie Munger and Warren Buffett aren't buying right now, it tells you one of two things. Either they think these assets are bad and they don't want to own them, or they think that prices are going to go much lower and they'll have a chance to make purchases then. Either way, keep watching Omaha and Berkshire Hathaway. Until they act, the problem may not be over. Another thing to keep in mind is that if First Republic Bank has gone down, alongside Silvergate, Silicon Valley Bank, and Signature Bank, you would think that the government would step in and make sure there was no other banks under pressure. But now we are seeing multiple other regional banks. Their stocks have sold off more than 50%, and people are becoming quite antsy. They're pulling their deposits, and they're moving to the larger and larger banks. If that continues, there's likely to be more bank failures in the near future. Now, of course, these banks, it's been well documented that they have all sorts of treasuries and bonds that are trading underwater. And so if they're forced to liquidate them, they could wipe out their equity and ultimately be insolvent. But on top of that, there's another problem that is brewing. Charlie Munger actually called it out. The commercial real estate loan books on these banks, they're in trouble as well. There currently is a building in San Francisco that previously was valued at more than $300 million. And now there are all sorts of bids coming in for it for 60 to 80% off that previous valuation. Now, why would there be bids that are 60 to 80% lower? It's because the building's sitting there. It's basically empty. Commercial real estate has been torpedoed by remote work and people wanting to live in better places than packed in some of these urban areas where crime or other issues are running rampant. And so if you're a bank and you are lending against an asset that you thought was worth $300 million, but it ends up being worth 80% less, your loan's in bad shape. And so although there's things like treasuries that eventually will get paid out on par, those commercial loans, it would take forever for the US government to go in and underwrite every single loan and understand what the true value is. That causes complexity and challenges for banks. Because yes, the government may be able to take some of their fixed income and some of those treasuries and bonds, but I don't see a world where they're going to start taking commercial real estate loans and say to the banks, don't worry, you can offload your risk to us and we'll simply give you $1 at par value. That'd be wild, but maybe I'm naive. Maybe we shouldn't ever say never. The last thing I'll say about the current banking crisis and the second largest bank failure in US history is this had nothing to do with crypto. Previously, critics of the crypto industry, they blamed Bitcoin and cryptocurrencies for the failures of Silvergate, Silicon Valley Bank, and Signature. But now with First Republic Bank, there's no one trying to make that argument. And so people must wake up. They must realize that there was a banking issue, not a crypto issue at play. As we continue to move forward over the coming months, one thing to pay attention to is a looming recession. Someone like Stanley Druckenmiller, who's compounded capital for over 30 years at 30%, he's short the dollar, and he believes that there's going to be a recession, that there's going to be a devaluation of the currency, and a return back to loose monetary policy.
I'd say the one area that I feel reasonably comfortable in is I'm short the United States dollar. Currency trends tend to run at least 2 or 3 years. We had a long one here, over 10 trillion, something like 13 trillion came into the US dollar during the previous decade. I will say, full disclosure, I missed the dollar. It's probably the biggest miss in my career in currency trades. I missed the last 9 months run up in the dollar. I just couldn't bring myself to own Joe Biden and Jerome Powell. I think now that on a relative basis, the tightening in the U.S. going forward will not be as much as the foreigners now that we've weaponized the dollar, and you've got people like Lula running around asking why we need to be trading in U.S. dollars. By the way, it's not a bad question. Historically, we could be trusted. We had a rule of law, a lot of things. So about the only space I have any risk on right now is in the U.S. dollar. Don't run out in short dollars. I could change my mind in a week. But that's where I am right now, and I'm also long gold, obviously, for the same reasons.
If Druck is right, then we are in for a bumpy road. We'll continue to get that devaluation of the dollar. We'll continue to get all sorts of chaos in financial markets because of a recession, and none of that is addressing the bank issue. The banks are on all sorts of uneven, unsteady ground, and then we get hit with a recession, which causes the central bank to pivot. That, my friends, is utter chaos in economic terms. Stay safe out there. Keep your head on a swivel. Keep paying attention to what's going on with the banks, with the Fed, and with a potential recession. We are in unprecedented waters. I think we'll get to the other side and be just fine. But between here and the other side, I have no clue what's going to happen. And I just hope that a lot of people don't end up getting hurt.